Hi there, Evan here with Crypto and Markets for Wednesday, August 29th, 2018. A reason for today's video, I've been getting a lot of questions the last couple of days talking about the Canadian yield curve and what it all means. I put out a tweet, I believe 2 days ago, talking about how the 10s, 30s, 10-year yield versus the 30-year yield had inverted, which means the 10 years now yielding more than the 30-year, and effectively what this all means. I'll go ahead and summarize it in this video, and also I'll talk about some of the points you've seen on TV trying to discredit it. I'll go ahead and cover those as well. Now, firstly, the yield curve. As the economy is going up, the 10-year reflects greater growth potential, greater inflation expectations, greater capex investment, etc. And the short end, the central bank, to counteract that, has to go ahead and raise rates. That's the whole idea behind it. Now what's happening now? As the economy has started to turn down, the 10-year has started to work its way lower. Our real estate market, where we have a heavy reliance, has started to slow. You can also factor in car loans, consumer discretionary, furniture, appliances. They've all started to slow down. Even job growth has started to slow on the full-time side, especially the last about 3 or 4 months. So the growth expectations, as they've slowed, brought the Canadian 10-year down. Pricing in demand slowing, pricing in lower capex, so that's come down. Now you have the 2-year yield basically about this level here right now. The Bank of Canada still has a tightening bias, saying the economy is doing great while we're actually in a deflationary spiral because of real estate. You want that covered? I did a video on it 2 weeks ago. I'll link it down below. So basically, this is where we are. The bond market's telling you this, but the Bank of Canada is telling you it's more like this. Where in reality, we're like this, right? This is the 2-year, this is the 10-year. Yield curve very flat. In fact, I think it's only around 15 basis points right now. And what we're pricing in is one more rate hike here. This comes in a little bit more. And then we have the inversion. Now, why is this inversion so important? If you look at recessions, virtually every time there's been an inversion of the 2s, 10s, there has been a recession within 1 year after. In fact, in the US, every time the 2s, 10s have inverted since the 1950s, that is in fact what's happened. They've gone into a recession ultimately. Now again, where to watch, it can stay inverted for a while, but when the recession starts, it starts to re-steepen back out again. And that's what you got to watch for. As soon as this 2s, 10s invert, where the 2-year is yielding more than the 10-year, when the spread starts re-steepening back out, that's usually when the recession starts. In fact, actually, how about this? 2 things I want to mention as well that I've heard that have gone ahead and discredited this. Firstly, it was mentioned on my feed about a couple of days ago. I saw this talking about how in Canada, because we have a lower supply of duration, etc., the indicator means nothing. Okay, all I gotta say to that is, just look at the data. Look at where we are right now. Look at our housing market the way it is currently. Look at how much of a reliance we had on real estate, for God's sakes. I mean, it's all right there in front of you. I mean, if you choose to ignore it, I'm sorry, I can't really help you on that. And then, of course, there's these guys on TV, all these stock guys saying, oh, it's a questionable indicator, etc. Meanwhile, it's virtually right every single time, so I don't know what else to say. In fact, I will link this down below as well. Josh Galt did a great video, I believe on Friday or Saturday, talking about Canada's credit default swap spreads, the CDS spreads. I'll have you go ahead and watch the video, but I'll leave you with this. If things were so great in Canada, why is the bond market pretty close to pricing in a debt downgrade? Watch the video. I'll go ahead and leave it there. Just to go ahead and put it in closing, all this stuff you hear about the yield curve, how it's unreliable, etc. I'll tell you what. If I were to bet on the bond guys versus the stock guys, I'm taking the bond people every time. And that data tells me the bond guys are right. That's all I gotta say. Hit the like button, leave a comment down below, subscribe for more, and most importantly, follow me on Twitter @CryptoMarkets2. Y'all have a good day, everybody.